Oops. All right, let's do it. I'm associate member of T3 Trading Group. I'm associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All trades are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. And let's talk about the stock market. We're back above 400 after hours, huh? We closed below it, but we're back above it after hours. We just bounced like $1 here when the market closed. That's what I wanted to see it close above 400. Look at this price action here by the end of the day, though. Very sloppy overall on this. Daily chart, no real updates, I don't think, on this daily chart. We got an upside tail and a downside tail, so basically a doji candle from today. Still above major support of 390, still below major resistance of 410, and basically sitting right at this key 400 inflection point as of today's close. So, yeah, super volatile day off the CPI. Qs here, similar story. We're below 295, major resistance. We're above 280, major support. IWM still trying to hang out above this 180, 180.50 area. IWM has a lot of work to do. Excuse me. I was definitely encouraged by the relative strength from the Russell today overall. With all the volatility today, SPY's closed down about 0.5%, Q's closed down about 0.6%, IWM closed down about 0.4 percentage points. So, yeah, going back to the 5-minute chart for the market here, you can see 2 o'clock, Fed announcement hits, 50 basis point increase. They sink us down. We build out this wedge. The wedge breaks to the downside at the beginning of the press conference. But things were definitely not looking good. And I'll tell you, the thing that scared me most, so, look, 50 basis points, fully expected. Everyone was expecting that. The slightly scarier things, as far as I'm concerned, were the other revisions that the Fed came out with, right? So, GDP forecasts down, unemployment forecasts up, dot plot, terminal rate higher, more aggressive, that we're going to continue to see slower but still rate hikes throughout 2023. That all sounded terrible. And look, we were expecting, the markets move based on expectations, right? So we were expecting the 50 basis point increase, fine. We were expecting the terminal rate increase, dot plot increase, fine. I don't know if we were expecting that GDP unemployment numbers to change like that. So it wasn't great. Markets broke down. To me, honestly, I was scratching my head. It felt like we should have been down more based on that. That sounded like really, really bad. It felt like we should be down more. Yet, we weren't. Not only were we not down more, we actually had a hell of a rally back in the market today. With this move, and this was like my best trade. When this wedge broke to the upside, the confirmation was the UUP, the dollar, was coming down and making lows here and breaking this 28. We called out the SPY long here, the market long here. I bought SPYs specifically, bought some other stock too. This wedge breaks up, gives a great trade. Then we called out, profit taking into highs because I felt that breaking the opening high here would be really difficult. Breaking high of the day would be really difficult. The IWM actually was able to tick back to that high, but it was not confirmed by the SPYs and the Qs. Again, one thing that I'm a little bit encouraged by today broadly is the performance in the IWM. And then we broke down harder than I would like to see, to be honest. In this pullback, I was not looking to be aggressive at all. I felt that there were good opportunities earlier in the price action. And then once we got this bigger bounce here and we looked to book profit into that area, I was not really trying to do too much from that point to the close. Just kind of sit back, wait and see, and watch the price action to see specifically how we close. So, kind of a sloppy, choppy day. We had some great calls today. We had some great calls, really starting from the beginning of the day on. The game plan this morning pre-Fed was to take it easy, especially midday. No reason to put on a lot of risk. The market could be not giving us a lot. The market did give, a decent little kind of upside grind at one point today coming into when the Fed actually hit. There was a few good trades that were there that were discussed. I remember specifically we were looking at SoFi above like 470. This gave like a great little pattern in here that also got called out, this bullish consolidation for a break. But it's a really slow mover. RNG ring here for 40, and one of you guys called it out when it first got up to 40. Too spready, too much risk, but it built this nice consolidation here, and someone called this consolidation out right as it was breaking, right as it tightened, right as the ADMA caught up. So RNG gave a great trade. Plug, one of you guys brought up in the morning meeting today as a trade through 15. That was like awesome. Really good momentum move through 15. Gives a bounce up to 1560. Price correction a little bit deeper than you would want, but price correction down to the ADMA, that upper band of equilibrium. Little inside 5 here on this break of this pattern as that ADMA caught up for a second trade for good upside continuation there as well. So, you know, bottom line is you look at the market, you look at the daily candle of the market, you scratch your head a little bit. You know, we got this big candle of uncertainty here. We didn't break below any key levels. We didn't break above any key levels. I'm still a little bit surprised that we held in as well as we did, given some of the comments that came from the Fed today. It is really becoming all about the economy, like we've been speaking about for weeks. You know, the Fed can do what they're going to do and say what they're going to say. We need to see what the earnings reports look like. That's going to be the biggest thing for this market going forward. So, you know, we'll wait and see on earnings reports. And the only other thing I want to point out, and I mentioned in the morning meeting, but I want to mention it again, I thought was really interesting piece of information that Pat had in the morning note that comes from Goldman that we discussed in the morning meeting. I still think had an effect today. So this was from this morning, you know, based on yesterday's price action where that CPI came in light, but there was not a crazy, insane reaction like we discussed. It's this paragraph right here. We think options expiry prevented a move to the top side today. 3.9 trillion, not a typo, worth of options expired this Friday. This is why we were pinned from 4,000 to 4,100. The market has the ability to move freely post-expiry. If it's going to move, this starts next week. So really thought that was very interesting commentary based on, especially, you know, we're constantly paying attention to the options market, what it means. Friday is going to be an insane day. So it's like yesterday was good news. I didn't expect a massive upside reaction. I think that these, you know, CPI and Fed moves are going to start being a little bit more muted than they have been at other parts this year. But I didn't expect on good news for us to sell as heavy as we did. And then today's the opposite. Today yesterday the news seemed better than SPY 400 to me. Like we should be a little bit higher than that. Today the news seemed like it was really bad what came out of the Fed, yet we were still able to actually hold in. So this stickier price action that we're seeing could certainly be a result of, you know, Friday's upcoming expiration. It's just going to be a massive number. And then Goldman could be right. You know, maybe we loosen up starting next week, and then we'll see what this market wants to do into year end. You know, we don't have a lot of time here. You know, you do have the, you know, Santa Claus rally, January effect that begins to come into the market, but you know, we've only got a week and a half left on the year. I can't believe it already. Actually, it feels like 2022 just got started to me, and it's the end of the year. This year went so fast, and the market is closed on the 26th. So you know, we've really only got like 2 weeks worth of price action left on the year, and that, you know, week between Christmas and New Year's is sometimes pretty light. So we'll see what happens. Then going into 2023, we have got a lot of fundamental headwinds in front of us as far as recession, depth of recession, what the economy looks like, what earnings reports look like, but we'll obviously take that as it comes. And I'm almost there, Mr. Smoke. But that's all I got for you guys today. I do got to try to get out of here at 4:45. I should have mentioned that in the beginning. Yeah, I believe it. But hey, man, as long as I can keep getting on the slopes, that's all I care about, right? I know you're with me on that one. Got to take it one. Snowing, dude. I can't believe I'm not out there. I saw Targi has like 150 inches so far on the year. It's sick. From Bill, my father-in-law says, life is like a toilet paper roll. It goes faster as you get to the end. That's a good one. So that's all I got, guys. I got a few minutes here. I do got to dip out a little bit early, but I'm happy to answer any questions on today's price action. Obviously, there's a lot to kind of unpack here. So yeah, and you deal. I like that, J. Cole. What did Bill Ackman say? Was that a deep job just destroying recession?
No, he basically said 2% of inflation is ludicrous. If we get to 3%, then we're good.
I think that 3% is actually the historical average for inflation or something like that. Like 3% really should be like an acceptable level. Obviously, we want 2%, but let's get to 3% and then take it from there. What else, guys? I'm happy to do a quick one, but I know that there was a lot to unpack, so I'm also happy to answer questions. That's what I'm here for. From DJ, when it comes to profit taking, do you think the average trader tends to be too conservative? Yes, I do, in the sense that they cut too much too early, or too greedy, in the sense that they hold too much too long. The average trader, obviously every trader has their own strengths and weaknesses and psychological issues that we all kind of deal with that are going to affect how well you're able to hold stock. But what people, if you want to talk about the average trader, tend to do is they tend to book their profits too early and hold their losers too long.
I was just going to say the same thing.
Whatever psychological reason that is. People want to hold their losers. They want to be able to come back. They don't want to realize that loss. And then when they've got winners win their money, they just want to book that money as fast as possible. And honestly, fighting those psychological demons is like one of the biggest keys to the business. Knowing to be able to consistently cut losses, that doesn't matter. There's always going to be another trade. And then having that appropriate game plan in place for reward maximization is super important. And look, I'm not saying don't book any profit early. I'm saying it depends on the trade that you're taking. If you're taking a counter trend trade, you should be booking profit earlier than a with trend trade. You guys know I'm a big believer in selling stock to cover risk, but that's more risk management than profit taking. But for me, I mean, you guys see how I trade. Once I've got a position and I'm in like a win-win on that, I'm going to be as greedy as I possibly kind of can be, within reason. Obviously, I'm going to have a game plan in place to make sure I'm booking profit, trimming, trailing, all that stuff. But once I'm in a win-win situation, I've really learned over the years, the big P&L comes from holding for big moves of big size. I mean, it sounds obvious, but it's very true. So if you want big P&L, but you're never holding for a big move, how are you expecting that to happen? And if you're never able to have size, same thing. How's that going to happen? You want big P&L, it's big moves on big size. With that said, we've got traders of all experience levels here on the team, from newer traders to professionals with decades of experience, guys with small accounts, guys with guys who are managing hedge funds who are part of the team. So you when it comes to size, you want to build into size. If you're like a newer trader and you're just getting started in the business, you shouldn't be taking 10,000 shares of Tesla tomorrow on your positions. You got to be able to build into that and kind of get comfortable with it.
I think you can make a living taking profits early, but you have to know to cut the losses. Like you said, like the average trader holds on to the losers way too long. If you can figure out how to cut the losses very quickly, you can still make a living taking profits early.
And I have found that most of the times, if a trader is not able to be successful, it's the downside side of it that causes that. Not 100% of the time. I've definitely worked with traders or seen traders who are very disciplined on their downside, but as soon as they're making a little bit of money, they are liquidating their positions, and they're not going to be successful either. The key is, and I've looked at my own accounts and accounts of like a billion traders at this point. The key is whatever that downside number is, you have to be able to be consistent on that downside number, and whatever that downside number is, your good days, your really good days have to be a multiple of it. So, and I always like to use simple numbers, and then you can apply it to your own account. So if you're, I hope not, the rest of you guys can hear me. Test.
No, you're good.
I'm good. Cool, thanks. So if that downside number for you is $500, you should be able to look back at your trading reports and see every negative day I've ever had is never breaking $500. And then when you're looking at your trading reports, you need to be able to see that you've got that $1,000 day in, the $1,500 day in, the $2,000 day in, the $2,500 day in. It doesn't have to be that often. You don't need to be throwing in $2,500 days every other day. If your downside max loss is 500, you're never letting yourself lose more than that. And it's not going to always be that way. Sometimes you'll have a $500 up day, even though 500 is your downside. That's just part of the variability of it. But show me a person who never breaks that downside number and can, even if it's just once in a while, have up days that are a multiple of it, and I'm going to show you a trader that is consistently profitable year over year.
The number one trader killer is if you lose $500 a day on average, and then you have that one day where you lost $3,000. Like, you cannot.
Yeah, for sure.
That's why it's so imperative to like always stay disciplined, because the 1 second that you like are thrown off guard, it could literally be your whole month or whole year. Like, it's literally that important.
For sure. Next on here is Ricky. I tried Oxy at 10:32. Thanks for the timestamp. Oxy at 10:32. What was the XLE doing at that point? Wow, I didn't really watch this XLE that much today. I didn't realize that they smoked it early on. So you tried Oxy at 10:32. The low candle here is the 10:35 bar. Volume really sort of maximized at the 10:30 bar. Before I read the rest of your question, this is very typical. You definitely want there to be like a hammer on the bottom, but there's not always that. When it comes to maximizing volume, you also want your maximized volume to occur on the bottoming bar, but it's that way a lot of times, but it's not unusual at all to see the bar right before it be the maximizing volume, which is what occurred here. But let me read the rest of your question. I started at 10:32 back through 63. I like the trade. I already really like the trade. I know what's going to happen. You're going to get stopped out. 6 cents risk, super extended, maximizing volume. You bought it on the way back up. Tight risk. That's, tight risk, little low probability, a little bit of a, higher probability of getting shaken out, which is probably what's going to be what happens to you. But I really like everything I'm reading so far. Use the 10:30 low. I was looking to try it again around 62.50, but that next pop was the low, but I didn't take it because of the low volume. At the low in the 2-minute candle. Okay, I don't love the 2-minute candles that much, especially at this time of the day. I really don't like the 2-minute candles. I think you should be looking at that 5-minute candle. Was this the right decision thinking, or should I have taken that again at the low? Also, where you look to book profit since energy has been shorter term bearish. Sure. So I really love your first trade here. It's unfortunate that you didn't get in a second opportunity. This candle looks like it was very difficult. I like using those like whole type numbers, especially if the whole number is in conjunction with a level, which 63 is not really a level. 62.50 is the big level. You're right. So I like that you tried this back through 63 a lot, especially with the volume, the extension, everything we just discussed. 62.50 would have been great for a similar trade. It just didn't give it to you. If there was a hammer on this candle, you could have tried that as well. The lower volume, agree with you, not ideal, but like I was saying before I finished reading your question, we want the volume to maximize on the lowest candle. It's not unusual if the volume maximizes on the candle before the bottom candle here. So, again, unfortunate that you didn't get in, but it's the right thing to not push it if your trade's not there. So you were looking for something specific, you tried something specific, the risk on it was low, you got pushed out, fine. Second trade just didn't set up properly for you, so you didn't get in, you missed the move. Just recognize it's a better job to not get in and miss the move than to force the trade if the trade hasn't actually set up for you, and I would agree with you that the trade never fully set up for you. So I think that is a good thing to do. Where on profit taking, so first thing I'm going to do on profit taking is cover my risk, like always, especially so on counter trend trades. Target number 2 is going to be the ADMA, right? The lower band of equilibrium. Sorry, I guess that's target number 1, because I don't count the 1-to-1 kick or whatever to cover your risk as a target. So target number 1 is going to be the ADMA, that lower band of equilibrium. Target number 2 is going to be the 21 EMA. That's what I'm looking for a bounce. This is a counter trend trade. This trade should fail. It's counter trend on multiple time frames because the XLE has been weaker on the daily chart also. This trade should fail. It doesn't. So then you keep a percentage of your position just in case this retracement higher actually becomes a reversal. don't know if anybody here knows Dave Lancelotti from our risk and operations team, but he's like getting naked in front of me here. Basically, I have no idea what's going on. Dave, this is a place of business. I hope I answered your questions there, Ricky. I hope that helps. Anything else, guys?
Yeah, there's one more. Do you trade a fixed risk or fixed position?
What?
Do you trade a fixed risk or fixed position?
Oh, I missed it from Dan H. Do you trade a fixed risk or fixed position size? So I don't do fixed anything, but the way that you should be making that decision is going to be based on risk, not on position size. I'm actually a big believer in not trading a fixed position size, because you shouldn't be taking your size and then figuring out where the stop loss is supposed to be. It's going to become a very random amount of risk. You figure out, how much do I want to risk in the trade, right? I want to risk $100 in this trade. How much is the next question? So question number one, how much do I want to risk in the trade? I want to risk $100. Question number two, well, where's the appropriate stop loss? Okay, the appropriate stop loss is 10 cents down from where I'm about to buy. And then you back into the size. So if I want to risk $100, it's 10 cents worth of risk, I'm taking 1,000 shares. If I want to risk $100 and it's 20 cents worth of risk, I'm taking 500 shares. That's the equation by which you come up with the size that you're supposed to be taking. And it should be based on the risk amount. If you're just taking, like, I take 1,000 shares in every position that I get involved in, all right, well, this trade calls for 15 cents risk, this trade calls for 40 cents risk. So you're risking $150 here and $400 here. If those are the same level of trade, meaning that they're equally good, that doesn't make any sense. Two trades that are equally good should have the same dollar risk, not the same tier size. So that's how you want to think about that, I think. And then even that, I think if you're a brand new, like, entry-level trader, having a fixed risk amount is actually a really good idea for your first, like, 3 to 6 months in the business, where you say, you know what, Dave, did you just put cologne on? Oh my God. I'm gonna have to end this meeting immediately. Oh, I like totally lost my train of thought.
My natural must. Fixed risk.
I can't wait to get out of New York and get out of this office.
Fixed risk for
I can't wait to not see Dave Lancelotti from the risk and operations team for at least 6 months. Though he's a great guy, and if you ever have the pleasure of working with him, he can be a little bit grumpy sometimes, but
he smells good.
He's actually a great guy. I don't wear cologne. That's like, I don't know what that's about. It's like a 1990s thing, and Dave, you know, he's still kind of living in the 1990s a little bit, I think, with his Diet Coke over here.
Well, that could help fill 30 seconds.
Back to the question. So I think if you're a brand new entry-level trader, it makes sense to risk a fixed dollar amount for your first 3 to 6 months, because it's less decisions that you're going to make. So I risk $100 in every trade. Then the question is, am I in or am I out? If you're in, all right, here's my stop loss, how many shares am I taking, I'm in. And then figure out your game plan for the upside. It complicates things, but it's also extremely important to have what I call risk skew. If you want, so I think that if you do fixed risk, it's really going to limit your profitability. Yet I still think new traders should do that, even though it limits their profitability because they're new and they're learning. An experienced trader should have a risk skew based on how they grade trades. So if this is a not so great whatever trade, I'm risking $100. If this is a B trade, I'm risking $250. If this is an A trade, I'm risking $500. If this is an A plus trade, I'm risking $1,000. That's an example of a risk skew. And then you judge where you are in the risk skew based on risk reward and probability of success on each individual trade that you're taking. And I really think that that's the key to actual big profitability in the market, is implementing an appropriate risk skew. But it should still all be systematized, more or less. You know, we're not robots, we are humans, but we need to have some qualities of a robot sometimes with the flexibility of a human being. And that opens up a whole other can of worms into robot traders versus human traders. A lot of people think that eventually there will be no room for human beings at all. It's something I very much disagree with. I just think that robots have certain strategic advantages. Humans have certain strategic advantages. You need to know what those advantages are. I can't compete with the robots on speed, right? And robots are going to be very systematic in what they're doing. They're just going to do what they're programmed to do. But a robot will never be able to be as flexible as I'm going to be able to be as far as changing thought process based on, you know, a new market environment or something like that. You're operating a robot, the market environment changes, that system's not profitable anymore. You have to take that system offline, recode it, reprogram it, you know, figure out what the new approach actually has to be. So hope that helps. Dan saying I have a hotkey that auto calculates the risk off where I place my stop. Okay, that's what I do. I have several different hotkeys. Okay, yeah, good stuff. I kind of do it in my head. Trader math is definitely really important. From Dave, when you say cover your risk, are you looking to use one risk unit or more? So I don't really use the term risk unit. It's a little bit foreign to me. But when I mean cover the risk, an example of that of what I like to do, which we talk about one-to-one kicks all the time, or you might see somebody in the VTF type in, got my one-to-one. What that means is that they've covered their risk on the trade. So again, just to use a simple stock trading example, you bought 1,000 shares on 10 cents risk, like we were just same example as before. You got $100 worth of risk. You take 500 shares or 50% of the position, you offer it out 10 cents in the money. If you get that fill, that puts $50 in your pocket. You still have 500 shares. It's $50 worth of risk. Trade goes down and fails, it becomes zero for you. So that's what I mean when I mean getting your risk covered. That first sale that you're doing is going to be a risk coverage sale, so that your worst case scenario is now a donut. It's now zero, and then you can look for further success from there.
That graphic explains exactly what Derrick was just talking about.
Oh, cool.
It was created because of you.
I've never seen this before. Thanks for the question, Dave. Did you?
Okay.
Did you ever get any results from that hat experiment? What hat experiment? Oh, Optios. I'm not a good candidate, which I told them that probably ahead of time. But the cool thing is, the reason why I'm not a good candidate, the reason why they took me off the system, the brain reading system, is because I don't act on my emotions. I get emotional, but it doesn't change my process. I'm very systematic in my approach to trading. And that entire brain scanning system is going to be based on an idea that traders get emotional, they make bad decisions when they're on tilt, they make good decisions when they have a zen-like brain state, and it's going to trade with you or trade double you when you're in a really good brain state. It's going to trade against you, take the opposite side of your trades when you're in a bad brain state. So after a few months of wearing it, the feedback I got was basically the exact same feedback I told them when they told me that they were going to use me as one of the initial experimental people, which is that we're just not getting the signals off of your brain state where this is going to be able to be optimized to be profitable. I was like, yeah, you should just follow every trade I take if you want it to be profitable. I mean, I certainly have plenty of trades that fail and cost me money, but on net. Cool.
I'm being told to wrap it up.
All right, I'm being told to wrap it up, and I do got to wrap it up. So appreciate you guys. Thank you for the questions. I will see you all tomorrow. I hope you all had a good day, a good night, and that's all she wrote.